Two numbers live in separate universes, and they're about to collide. On one side is the physical world. Factories, power grids, data centers, solar lines, defense systems, things that either ship on schedule or fail. On the other side is the financial world. Deficits, debt rollovers, currency creation, and portfolios so large they can overwhelm markets simply by turning their heads. Silver sits at roughly $77 an ounce in your feed, ordinary enough to scroll past. But that calm number masks a structural problem. This metal is being asked to do two jobs at once. It is an industrial input that modern technology cannot easily replace, and it is also a monetary refuge when trust in paper claims starts to thin. When those two roles pull in the same direction, price doesn't rise. Price re-rates violently because there isn't a deep ocean of available metal waiting to meet a tidal wave of demand. Here's the thesis, stated plainly. The silver market is not built for institutional panic. It is not built for a world where industrial buyers stop acting like shoppers and start acting like planners securing lifelines. It is not built for a moment when the largest pools of capital on Earth decide that even a fraction of a percent of their wealth needs tangible protection. And yet, that is the environment described by the math in front of us. Flat mine supply, accelerating structural demand, and a monetary backdrop where governments are cornered by their own balance sheets. Most people picture commodity moves as a story about mining, or speculation, or charts. This is a story about scarcity meeting scale, about a market so small, in investable terms, that it can be dwarfed by decisions made in a single committee meeting, about a metal measured in ounces being pulled into a world measured in trillions. So ask the question that frames everything. What happens when the financial system discovers it needs something that doesn't exist in sufficient quantity? Not wants, needs. Because when that realization arrives, the price is no longer negotiated, it is discovered. To understand how this becomes possible, we have to go back to the blueprint, how silver is produced, who consumes it, and why the supply response that works for normal commodities breaks down here. Start with the simplest truth. The world pulls roughly 830 million ounces of silver out of the ground each year, and that figure doesn't flex the way people assume it should. In a normal commodity market, higher prices lure new supply. Silver doesn't behave normally because most of it isn't mined on purpose. The source material states roughly 70% arrives as a byproduct of copper, lead, and zinc mining. That changes everything. You don't turn up silver production like a dial. You need new base metal projects, and those projects take a decade to move from discovery to meaningful output. The supply chain is slow, capital intensive, and bound to geology and permitting timelines that don't care about market excitement. Now layer demand onto that rigid supply. Total global silver demand in the source moves from about 1.03 billion ounces in 2020 to more than 1.2 billion ounces by 2025, with the trajectory accelerating. That alone implies a persistent gap, metal that must come from somewhere other than new mines. Then you find the engines of structural demand. Solar manufacturing is portrayed as a monster in the room. About 180 million ounces consumed in 2025, with a path toward 380 million ounces annually by 2030. That is not a seasonal preference. It's an industrial requirement embedded in the build-out of electrification and power generation. Then add the second engine, electrified transport. The source asserts electric vehicles use roughly 3 times the silver of internal combustion vehicles, which means each marginal shift in the global fleet pulls more silver into the wiring contacts and systems that have to be reliable under heat and vibration. Add the third engine, AI infrastructure and data centers. The material cites a single company's build-out, Microsoft, at an estimated 15 million ounces over 3 years, and frames it as one participant among many in a race to expand compute capacity. When you stack solar, EVs, AI infrastructure, medical devices, advanced electronics, networks, and defense applications, you get an uncomfortable picture. Demand that behaves like a one-way ratchet, while supply behaves like a locked door. If this pattern is starting to click, if you can feel how a small deficit becomes a strategic problem, hit like and subscribe. It helps this reach the people who still think silver is just a chart on a screen. Because once we leave the industrial layer and enter the monetary layer, the scale of what's possible changes. And here's the expectation breaker. The industrial deficit is only the first half of the mechanism. The second half is what happens when monetary stress pushes capital toward tangible assets in a market that is, by the source's own numbers, shockingly small. Now we bring in the pressure that doesn't show up on a production spreadsheet. Sovereign math. The source paints a fiscal landscape where the United States runs annual deficits exceeding $2 trillion, national debt surpasses $36 trillion, and the trajectory adds roughly $1 trillion every 100 days. It frames debt service as swelling into one of the largest budget line items, then widens the lens to Japan's towering debt-to-GDP ratio and Europe's recurring sustainability worries. Whether a viewer agrees politically is irrelevant here. The mechanism described is mathematical. When interest obligations consume more of revenue, the menu narrows until it becomes brutal: default, austerity, or monetary intervention. The source argues the system chooses monetary intervention because it has to, and that choice has consequences for anyone holding savings inside the currency being diluted. This is where silver's second identity matters. Gold has a long history as a store of value when currencies degrade. Silver shares that monetary lineage, but it also has the industrial bid that doesn't vanish just because prices rise. That combination can turn a standard flight to hard assets into a crowding event: monetary buyers and industrial users reaching for the same limited physical supply. Then the curtain pulls back on the most important scale mismatch in the entire narrative. The source claims the global investment-grade physical silver market, bars, coins, and allocated holdings that could realistically be sold to investors, is worth roughly $50 billion at current prices. $50 billion? In a world where pension funds alone manage around $50 trillion. In a world where insurance balance sheets and sovereign wealth pools move in the tens of trillions. If even a sliver of that capital decides it needs tangible exposure, the market size becomes the story. The source gives a concrete example. If pension funds allocate just 1% to physical silver, that $500 billion, pressing into a market valued at $50 billion, 10 times the purported available supply. In a market like that, price doesn't adjust. Price gaps upward until sellers appear, and sellers only appear when the number becomes high enough to force capitulation, substitution, redesign, or rationing. And history, as presented in the material, gives the viewer permission to imagine moves that feel unreal. Silver climbs from around $6 in early 1979 to $50 by early 1980, a surge framed as more than 700% in about 14 months, driven by monetary instability and concentrated buying into an already tight backdrop. Everything so far is the setup. The revelation is what happens when ratio dynamics, institutional scale, and claimed signs of physical stress begin to align at the same time. The most dangerous thing in markets is not greed, it's revaluation. The moment the crowd stops debating what something should be worth and starts paying whatever it takes to secure it. The source builds its pathway to extreme outcomes through a simple bridge between gold and silver, the gold-silver ratio. It places the ratio near 64.5 to 1 in the present framing notes, a long historical average around 50 to 1, then highlights how bull market finales compress the ratio down to about 31 to 1 in 2011, and briefly near 17 to 1 in 1980. The point is not that history repeats on schedule. The point is that ratios can snap when psychology and scarcity combine. From there, the source runs scenarios. With gold at 8,000 and the ratio at 40, silver lands at 200. With gold at 12,000 and the ratio at 30, silver reaches 400. With gold at 15,000 and the ratio at 20, silver approaches 750. These are not five-figure numbers, but they establish the mechanism. Gold revalues upward in a monetary crisis. Silver follows with added torque when the ratio compresses. Then the narrative crosses into its most extreme domain, a reset logic where gold is revalued far higher in nominal terms to restore confidence in currencies. And silver's scarcity forces the ratio tighter than expected, because industrial buyers are not optional participants. In that world, the source sketches gold at 50,000 with ratios that imply silver in the low thousands, and it argues five-figure spikes become conceivable during a mania phase if industrial users and monetary buyers collide in a market that cannot expand quickly. Here's the question embedded in everything we just heard. If even a small slice of global capital decides it needs physical protection and the industrial world decides it needs guaranteed supply, who gets paid out and who gets shut out? Drop your analysis in the comments. Not your prediction, your mechanism. What breaks first? The paper claims, the delivery system, or the price itself? The source also offers claimed near-term stress signals, presented here as claims from the material, not independently verified. An alleged late January attempt by a major Chinese solar manufacturer to secure 5 million ounces for 6-month delivery, offering a 12% premium, only securing 2.8 million. An asserted February 3rd change in Shanghai delivery rules to prevent a squeeze. Claimed declines in exchange inventory since mid-2024. A reported January pause in U.S. Mint Silver Eagle production, followed by rapid sellouts when sales resume. Retail premiums expanding into the high teens and low 20s over spot, and London delivery times stretching from days to weeks. A claimed January 24th classified meeting convened at cabinet level around defense-related silver supply. Whether every detail holds up is not the point of the narrative arc. The point is the map. When a metal becomes both a bottleneck input and a monetary refuge, stress leaks out through premiums, delays, rule changes, and emergency attention, long before the headline price tells the full story. And this is where it stops being about charts and becomes about your life. because the real consequence of monetary debasement and industrial scarcity isn't theoretical. It lands in purchasing power, in savings, in the cost of living inside a system that quietly changes the rules. So let's close the circle, back to the calm number that started this. Roughly $77 an ounce looks manageable. It looks like a commodity doing commodity things. The source's argument is that this calm is a disguise, because the system underneath it is already strained. Annual consumption exceeding annual mine supply by a large margin, above-ground inventories acting as the shock absorber, and supply unable to respond quickly because silver is largely a byproduct, not a primary target. Then, in the same frame, you have a monetary world that is cornered by debt arithmetic. When deficits remain enormous and debt service becomes politically unmanageable, monetary intervention becomes the chosen path. In that environment, tangible assets reprice not because they become magically more valuable, but because the unit of measurement becomes less trustworthy. That is the lens shift. The story is not silver is going up. The story is the measuring stick is being shaved down, and silver is one of the few sticks you can't shave by decree. But the resolution isn't a pep talk, and it isn't an apocalypse. It's a crossroads. One path is the status quo. Structural industrial demand rises, supply remains constrained, and monetary policy continues to erode purchasing power. In that path, price volatility becomes a feature, not a bug, and silver's dual role turns it into a pressure point in the global system. The other path is stabilization, fiscal discipline, demand substitution, major new supply, and a monetary environment that restores confidence. The source acknowledges that if the monetary system stabilizes, if industrial demand plateaus, or if meaningful supply arrives faster than expected, the most extreme scenarios do not materialize. That uncertainty is real, and ignoring it is how people get wrecked. The hard truth is that even if the thesis is correct, the ride is not clean. The material emphasizes violent corrections as the psychological filter that eliminates weak conviction. It points to historic drawdowns inside major precious metal bull runs and warns that silver-esque volatility can be brutal in absolute dollars as prices climb. That doesn't read like a disclaimer. It reads like a warning about human nature. Most people done-tea lose because they were wrong on direction. They lose because they were unprepared for what being right feels like. So here's the agency frame without false comfort. You don't control the debt trajectory. You don't control central bank policy. You don't control industrial demand curves. What you control is whether you understand the mechanism well enough to recognize regime change when it arrives, whether you treat extreme scenarios as pathways rather than promises, and whether your positioning matches your tolerance for volatility, not your appetite for headlines. We opened with two universes, the physical world and the financial world. If the source's math is even directionally correct, those universes are converging on a bottleneck measured in ounces. The system was designed to make that bottleneck look small, technical, ignorable, until the moment it isn't, because the empire doesn't announce the blueprint. It waits until the structure is already standing, and then it asks you to live inside it.